think I got it. I think I got it. Oh, yeah. Did you get it? Magnificent? Days like today, I wish it just passed real fast. Okay, I got my head back together now. What was I thinking? Spy. Well, SPY's down pretty big.
Ten-year note falling below 4% for the first time since February. Rick Santelli will be along shortly with more on
Get
that.
back on
While
YouTube.
gold breaks out to an all-time high, going above $2,500 an ounce. The CEO of Alamos Gold will join us.
And we are also looking ahead to the major tech earnings that are due out after the bell. Tony Sacconaghi will be here to talk about Apple. We'll also get the trade on Amazon and Intel along the way. Meantime, let's dive further into today's weak economic data. Jobless claims soaring to 249,000 in the last week. That's the highest level since a year ago, August 2023. Can you believe it's August already? I think it's hard to believe. Yeah. While the ISM Manufacturing Index fell to 46.8, suggesting a contraction in manufacturing activity. All this sending stocks and bond yields sharply lower. Let's make sense of it all with Dory Wiley, Commerce Street Holdings CEO. Dory, welcome. Good to have you with us. This would tend to confirm what I sort of heard as a subtext in what the Fed was saying yesterday. Number one was that they are much more focused today than they have been over the past 18 months on the labor market, on the employment side of their mandate. Do you agree?
I do agree. And if you look at the language that Powell used, it was very cautious in what he said. He didn't say he looked at it as weakening. He looked at it as normalizing. Now the market, if you want to say the sell-off today is economic uncertainty, which I'm not sure I want to say that, but if the market would take that as, well, we have a weakening of the labor market. That the Fed didn't go there yet. And I thought that was interesting.
Yeah, very, very interesting. And yet today you see that the jobless claims numbers were higher. We'll get the jobs number tomorrow, I guess. Isn't that right? We get it tomorrow. It's early, but we get it. We get it tomorrow. So that will give us further. It adds to the pile of data, doesn't it? That Dory, the Fed will be using to determine whether or not to cut rates come September. And I assume you would think that they are probably going to do that.
I do. I think he gave us that clear message yesterday about cutting rates in September. I think the real question is he going to have more rate cuts? So now if you look, the market, which has always been at odds with the Fed for the last several years, for some reason doesn't believe what they say. He downplayed future rate cuts, but yet the market did what? It bet on future rate cuts. And now there's a higher probability of 3 rate cuts by the end of the year than 2. And there's a divergence from what the message was with Powell.
And Dory, you mentioned that you weren't quite buying economic weakness as kind of behind today's sell-off. What do you think it is then?
It could be a combination, geopolitical, economic. So when you're talking about the sector rotation, these aren't small numbers coming out of big tech, right? They're billions and billions of dollars. So when it starts to move the price, then it starts to cause things. And so some of this, I actually think is an interesting opportunity to buy. I think the market is not so sold on a weakened economy. The market wants its drug of choice, which is low rates, right? So you see everyone kind of moving. The theory is we go to small caps, and it's been a nice play. But I think you got to be real careful in small caps because over 41% of them aren't profitable. And if you look back at big tech, something like an NVIDIA, this big sell-off on a company that has 50% margin and over 100% return on equity, this could be a good buying point.
You happen to like, or you think in terms of drug of choice, that 2 sectors might benefit here. That would be regional banks, as well as payment companies. You list 2 stocks, Huntington Bank shares and PayPal. Explain your argument for them.
Part of it's industry, right? Banks have been very cheap for a good while. And wrongly, the market has thought, well, they can't make money unless they have lower rates. So this rate cut coming up, and maybe 2 or 3, according to the market, will be very good for banks, very good for their stocks, and they had a very good July. Huntington's right there. It's got a good handle on its market. It has low commercial real estate exposure. It had only two banks in its peer group that actually grew deposits in the last quarter. And it's in a nice position for growth in markets like Texas and South Carolina.
And PayPal?
And now PayPal has been kind of a stepchild as of late. And it's actually cheap. It's a value stock. And they've been beating numbers, and they look really good. And I love the 10 times EBITDA for PayPal. So and consumers are still spending money. And you get rate cuts, they're liable to keep spending. And PayPal numbers look really good. And so I think it's a value play here. Good place to be.
You're the third person pounding the drum on them. I'm starting to take notice. I'm watching the CEO. What do they have up their sleeve on that front? Dory, quickly on big tech then, as you said, there's capital shifting around here. Do people need to go out of their way to avoid exposure to these names?
Well, I think you got to be careful who you're into. We've got Apple coming out later and Amazon, but they both still look very expensive to me. So, you're going like, you mean some of big tech is cheap? Yeah, I still think NVIDIA looks pretty good.
You do.
Microsoft, I'm watching pretty close, but I want to wait on buying into the dip on Apple and Amazon. I think I need them to see come down a little bit more.
All right, we'll see if that's prophetic based on what happens this afternoon or in the weeks to come. Dory, good to have you on today. Thanks for your time.
Thank you.
Dory Wiley. As stocks still off today, let's get the trades on some of those big tech earnings we were just discussing. David Traynor is with us. He's the CEO of New Constructs. And David, eager to hear your take. We'll start with Meta, which already reported. They beat those second quarter estimates, had better than expected forecast. The stock is up 4% in a difficult tape. So what's your trade on it now?
We think it's a hold right now. I mean, Meta is a super profitable company. We're really impressed with how Mark Zuckerberg has led the company post the metaverse thing. I think capital allocation is strong. They generated $60 billion in free cash flow the last few years.
God.
But the
$60
valuation
billion.
is rich. We think that most of the good news is priced in, so we're not seeing a lot of upside potential in Meta.
They've made a ton of money.
You're just sticking with it.
All right, let's move on to another tech stock. Amazon set to report its earnings after the bell today. Analysts expect the e-commerce giant and so much more.
We're at the
to show
21 on the
in
hour.
second quarter. Shares, though, down today, but up more than 20% so far this year. Your trade, sir, on Amazon.
Tyler, we're a sell on this one. Look, Amazon is a lot less profitable than people think. I mentioned Facebook's generated $60 billion in free cash flow over the last 5 years. Amazon has burned or lost $125 billion in free cash flow over the last 5 years. Most people think it's a really profitable business. It's not. It's very balance sheet intensive. So those margins are misleading because the capital side of the business is really just hemorrhaging cash at this point. That's why we've seen debt up around $180 billion, and we see shares outstanding growing. So it's not quite as strong a business. The valuation's still expensive as well, so that's a sell for us.
Before we dive into Intel, would you also stay away from Apple, which reports tonight?
Apple's got a better business model. Their free cash flow is super positive, high returns on capital. Apple's closer to Meta than it is Amazon, in our opinion.
All right, so that's a bright spot because I know Intel is maybe one you're not so keen on, and they do report. We don't want to overlook it. They just reportedly have these plans to cut thousands of jobs to finance a recovery. The shares still down about 4%.
Apple's back down to support.
4% this year, David.
Yeah, it's been a tough time for Intel. I mean, the business model has really fallen out of bed. I mean, a 0% return on invested capital when they used to be in the high teens. Free cash flow has been negative. And unfortunately, a lot of a turnaround is already priced in. So the market's giving Intel credit for getting back into business or back to form. But Kelly, we think that's probably good enough for now. I don't really see a lot of upside in the stock, given that so much of a turnaround is already priced in.
This was one of the great American companies, and it has been, and also ran now through several cycles here. Is it a survivor?
It's a good question, Tyler. I mean, you think with the CHIPS Act and all the capital flowing into domestic semiconductor production, that would be a huge, almost a windfall for Intel, and that's part of why I think that a turnaround is priced in. So I think it's going to stick around, but it's going to probably be sort of, making the chips that aren't so exciting, not NVIDIA type chips, but chips that, are running the toasters and the refrigerators and the cars, and maybe not the supercomputers. Still useful, but not a sexy stock.
Why is the market down 657 points on the Dow right now? What changed from yesterday?
Tyler, my crystal ball's in the shop, and so my day-to-day predictions are a little off. Look, who knows? I mean, this has been a wild market for a couple of years, and you guys understand how we focus on fundamentals, and we're looking at cash flows, we're looking at valuations, and we've seen so many stocks trade at entirely disconnected levels in terms of valuation and cash flows, both on the expensive and on the cheap side. There's a lot of great stocks out there that we still find. There's a lot that are head scratchers in terms of how expensive they are, the absolute ridiculous future cash flow expectations baked into them. And look, Tyler, in a market where Roaring Kitty has a real audience, I'm not going to pretend to try to predict what's going to happen from day to day if people are willing to pay attention to something like that.
Roaring Titty, is that what he said?
Thanks so much for your insight. We appreciate it. And
He said roaring titty. I know he said it.
Around an all-time high, with the price sitting just under $2,500, $2,483. Investors waiting on a Fed rate cut to send prices even higher. We're going to speak to the CEO of Alamos Gold when we return.
Was I thinking calls on Apple? Magnificent? What one? I know I lost a pretty good chunk of money today by being stupid. Do I want to take them now? We got a 1, 2, 3 setup. What I'm getting out of the deal is the market wanted a rate cut yesterday. Powell says we have the option of maybe doing it next time around in September. He actually said it. We got the election coming up. That's another big thing. I just can't see Kamala winning, but man, the Democrats, they stick together. It still could get rigged. The selling's not been that big today. It's been big, but it's been little bits. What time is it? Oh, it's 1:14. It's not the best time either. Yeah, I think we'll go down a little bit more. Maybe. Have a triple bottom. What am I doing? And that price is right around 240. So another little knife.
Welcome back to Power Lunch, everybody. Stocks are sliding sharply today. Look at the Dow down 1 2/3%, even more in percentage terms for the S&P, off 97 points, or 1 3/4%, and the granddaddy of them all, the Nasdaq, down 2 2/3%, 472 points at 17,000.
Puts, 550
Economic
puts.
data out this morning.
God, I wish I had
That's
them.
also having a big impact on bond yields, sending the 10-year back below 4% for the first time since February. Rick Santelli in Chicago, where he's following the action for us. Rick.
You know, Tyler, I know that many are focusing on the 10-year, but let's actually start out with the 2-year, and you'll see why in a minute. Now, as you look at an intraday 2-year, you could see that at 8:30 and 10 o'clock, we kind of fall off Niagara Falls there. Those were data points. So whether it was rising claims, weak PMIs, rising prices paid component, it all seemed to work against the markets today, pushing yields lower. But here's the fascinating thing. We closed the 2-year yesterday after its yields dropped during the press conference and Fed meeting down at 4.26%. We closed last year at 4.25. So basically yesterday's close was unchanged, and we sliced up and down through it until the data hit. So right now, as we sit at 417 and change, we're now down 7 basis points on the year on a 2-year, as you see on that chart. Now let's switch gears a minute to the 10-year. There's the 10-year. You can see also the same notions at 8:30 and 10 o'clock drops. And yes, we now have traded under 4%, as Tyler said, first time in February. But what I find fascinating is we settled a 10-year at 388 last year. So we're down 7 on the 2s, we're up 9 on 10s. And even though that isn't a huge difference, 16 basis points, it really does underscore what I've been saying is the most popular trade of the year. I have been a bit wrong thinking that
on the
long-term
SPX
rates would have a hard time getting under 4%. But I was definitely not wrong on the notion that the best way to play that is on a steepening or a less inverted yield curve trade, which has been very popular. Now, as you look at that 2-year chart of 2's10 spread, you can see that whether it was July of 22 or recently over several touches, this is basically the least inverted area it's been. And the reason it's so important is because long-dated treasury yields are the sell side of that spread, and many traders globally continue to say that the weak data is definitely a big deal, pushing yields down, along with a Fed that's definitely going to be easing. But in the grand scheme of things, don't underestimate debt, deficit, supply, and auctions, because they will rear their head. And the way they're doing it now is through the spread. We might see more active participation.
And I think we could probably get away with it here. We got a 1, 2, 3.
Election. And finally, the Bank of Japan's going to meet. Okay.
So here's SPX. We got a 1, 2, 3 set up. Man, if tomorrow drops, I think tomorrow we should be flat. But if we drop tomorrow, we might go down to the 21 on the weekly. Now, see, I didn't take it. I didn't want to, but I was getting ready to. What is this, the SPX? I'm going to still look at it, though, just because it dropped below. The first, the 54.40s on the call, yeah, Jim, you weren't fun today. Yeah, I'm not that much fun when I'm like that. Watch SPY, Randy, or MA. Might get a grade here. You might get a good grade. You might get a good grade. Might get a good grade. No. No, I'm not inputs. I was looking at calls. We got to break that trend line.
Ready to go at 12 p.m. Eastern on the Schwab Network.
Yesterday, I read a poem about time, and I'm going to add another verse to that poem. It's time to say no. It's time to let go. It's time to eat yellow snow. Arm. Hey, mama. Like. What am I just doing here? I said another alert? Dumbass. Oh, yeah. Well, no. Oh, man, we're very close to hitting it. 13 cents. This is number 4. You can count to 3. You can trade with me, but on the SPY, if you can count to 4, you might make a little more.
We raised our guidance for the second straight quarter by $25 million, substantially more than what we beat by. The numbers are the inputs, right? Or I should say the output. The inputs is what customers are wanting from Zeta. And what we're finding is that our platform is resonating really for 3 different reasons. The first reason being marketers see an opportunity for a replacement cycle. So how do I take my legacy platforms and replace all my point solutions with what Zeta can provide me, which is an end-to-end data platform, sophisticated marketing AI to be able to predict intent. And
Don't fight the trend, whatever you do. Don't try to fight it.
On the open web.
These guys are very bearish today.
To marry their in-house data with Zeta data. And then the ability to use our generative AI products to be much more efficient and effective in their marketing campaigns.
So this is a fast-growing marketing cloud and company. And so when you think about the competitive landscape, is there a competitive landscape?
Magnificent.
How do you
We got an inverted hammer or a hammer here. 245.
Legacy platform vendors that we're competing with. These would be the Salesforce, Marketing Clouds, Adobe.
We got the first bull candle right here, magnificent. First one. SPX. Magnificent. We got a huge snake with a falling wedge. We did that once here. I'm not in it yet, but I'm surely looking. I could have scalped it right there. 245 to 320. The 54.40 strikes. There, it dropped. Yeah, you can't fight these guys today. I wouldn't even try to be very aggressive at all. Not at all. I realized I was paying $22 a month on my phone for insurance. I've replaced this phone now 3 different times. Twice. I feel so stupid. I left to work without my apron, so I put my phone in my pocket, and when I bent over to wipe that toilet seat down, boom, big turd fell in the toilet. I bought a janitorial business 20 years ago so I could learn how to do this. And I'm about wore out of it, about done. I can do this full time easily. And the regulations and taxes. I mean, they got the government coming in one of the buildings that I do, and they got to test the drinking water. If it doesn't pass government mandates, they will have to go to another building. Yep, she's not doing her yet. Definitely failed on that one. I just can't give up on it yet, though. But I've been trading every day, and every time I see something that really looks sweet, I find myself a lot of times on the wrong side of the table when I do this, because I'm so bullish when I trade. Hanging there magnificent. I think it's going to do something soon. It's bearish right now. Abbott. May be quite a fire. Yep, we don't want to buy them yet. The market will tell us when we're bullish. We got 26 more minutes. I guess I can put my face on now. Boom. So YouTube, if you were going to grade me today, what kind of grade would you give me? I don't want it to be any better than a C. Okay, I'm going to show you people on YouTube the way that I do this right here. The way I draw a trend line in. I go to the first body. This is on the 1 minute. Now, you know, it depends on the time frame where I'll put that trend line. But on the 1 minute, I'll use the body. So I turn around and I take that body and run it up to the next one. And then just keep drawing it on down. This is called a head and shoulders right here. I know it don't look like much. This is called a wedge. This is bullish. But with the market, you don't want to take a big chance. Fat Cat said he was bullish on Meta. So on Meta, say I got a knock on the door. Jim, man, I want to trade Meta. Don't chase. Don't chase. Take your Fibonacci, put it right on top of that price line, go all the way down to the point of breakout. Right there. Perfect support. This pivot point inside of the Fibonacci. So I've got an automatic. Got an automatic Fibonacci set up here. That's on the SPYX. See these numbers right in here? That's Fibonacci. These right up in here, these are all fib numbers. This is called a TTM squeeze chart that I traded with for 18 years. If you notice lately, I've been using this one here. RSI and regular, just a regular chart with the RSI. No TTM squeeze on this one. Okay, we're back down to 335. Is this it, Randy? Is it time? Not really, Jim. Fat cats. I don't know. We might have some fun. $2.45, 54, yeah, 54.40s. There we go. Let's do it. Magnificent. Let's do it. Oh, I didn't put the date on there. Shit. August 1st. Oh, I'm in August 1st? Oh, yeah. That's all right. As a spy, I don't trade the same day. Okay, here we go again. Come on, hold this right here. Could have sold that, but I didn't. Inverse head and shoulders. Piece of crap. I think I was getting ready to have me a breakout there for a second. Ready wasn't ready. Come on. I just got one. Come. Oh, that's it. Almost pushed the trigger there. I have 12 more minutes. I'm gonna go get a cup of coffee and come back and see this thing at $3. Break at 54.23.55. Booyah, mama, yay. Damn. Not again. Well, there it goes. Man, I'm having a bad day today. Ugh. Shit. Exchange traded funds. It's not my day. Go out and have a big fat steak tonight. I ain't sold it yet. As long as we hold this support. But it's not. Should have added on right down there. What'd you do? Get out, Randy? I don't blame you. Should have probably added on to that, but and you were looking so good. Waiting.
For AI technology.
10 alerts.
And the more developers use it, the more tools are actually being developed based on that, and the more dependent they come. So that network effect that they have proven for years on the advertising side of it, I think that network, the same type of network effect, could actually be developing on the LLM or the pure AI technology side of it. So I do think they're investing in the right areas. And yes, I think we will see some pretty impressive return on that CapEx probably 3 to 5 years from now. Again, mainly on that AI technology side.
Yeah, Ali, just quickly, I see Jeffrey's $600 target, Guggenheim $600. Could this be a $600 stock soon?
Well, I mean, from a technical standpoint, it's passed that resistance of around, what was it? I think 485 today. So, the 52-week high is becoming more probable. In terms of 600, we've got it a little bit lower, but given how much progress these guys can continue to make and how they continue to beat expectations and make investments in the right areas, 600 appears to be a little bit more realistic. Yeah.
Yeah. All right, Tyler, what's your price target?
Yeah, we're probably in that 550 range. We're certainly not at the 600. I think you're going to start to see earnings moderate a little bit. You're not going to get the high 20% growth. So maybe the multiple stays around here, but earnings goes up 15 to 20%. So we'd be right around that 550 range.
Ali Morabi, Tyler Ellegard, thank you both. Good to see you. That's going to do it for us here on the watch list. Thanks for being with me. I'm Nicole Petalides. Every day, 11 a.m. and 2 p.m. here on Schwab Network. You can also download our free Schwab Network app in the Apple App Store. Keep it right here. Market on Close with Oliver Rennick next.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 6 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you. With unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees,
Break it.
and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location.
I should have added on right there too, but I didn't.
Cash moved to your brokerage account is available in seconds. That means you can stop waiting.
No stopping, no bounce. Why such a song? Because I think the market was looking for the rate cut. Now, we had others say September. They're not happy. Rate cuts should have happened a long time ago, but they didn't. My opinion. Well, hell. This will be my first red day in a long time. Oh, well. Got stuck in that stupid call. If I'd have held the puts, I'd be rich. $20 of them. Damn. Yeah. Also, YouTube, you got to think about what's going on in the Middle East right now, too. We're allowing the genocide to go on. Come on. Break. What'd you think about that guy beating the shit out of that girl at the Olympics? I had a girl that could probably whoop me at the time, back in high school. Shame on the Olympics, that's what I say too. There we go. There we go, Randy. Break it. I mean, this is an exit idea, but not where I'm at. That's probably it. Who knows, I might get 100% out of it. It's 4 minutes post power hour. I don't know if they're going to be that crazy to buy the power hour or not, but we're going to find out. I love that 63 EMA. I really do. That's a good moving average. Kind of wants to break, but we're going to find out. Hammer, 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 hammer. Could get out now and be smaller loss by far. All these things. NVIDIA back down to 107, Mike. They are having fun. We're waiting for you to break out. You can do it.
Because that thing came into this at like 95. So, I mean, how do you live up to that stuff?
You know, this is a tricky market because this is 2 days of extreme percentage moves.
Yeah.
I mean, big. And how about this little stat that'll shock people? Right now in the S&P 500, 5 up, 6 down in terms of sectors.
That's yeah, exactly.
Explain that to me.
Even comm services are up still because of Meta.
I know. It's incredible that 5 sectors of the 11 in S&P 500 are up on a day where, you know, we're sitting here down 2%. So the knee-jerk reaction is a global sell-off.
Yeah.
Bond rally, global sell-off. Well, 5 sectors are higher.
Well, those are the most domestic ones, basically.
Yeah,
so your point does stand.
But the ones that are down are the ones that are doing all the work and driving this market. So it's like the 6 most important are down.
Yeah.
The 5 least important are up.
And to your point, there is a whole other layer of macro on top of it with the bid into bonds after economic data.
That's alarming.
Yeah, I mean, there's just no world in which that happens for good reason.
Is alarming.
The move we've gotten here.
Bad news is bad news, though. I mean, this is
Exactly.
objectively a piece of bad news. It's about time we reacted like it.
Yeah, 100%. And this has been a normalization that's been creeping into the framework for some time. But that's where the logic's always been broken on the small cap stuff the last 3 weeks, is because that's what depends on the economy the most. People are going to start talking about 50 basis points, I think, soon.
Well, if you're at 100, there's only one more place else to go.
Right.
And that is...
Because the market's pricing in 3 now.
Yeah.
75.
I think people are talking about 50 basis points already. I heard that yesterday, at least on like Twitter, X, whatever.
Yeah.
I'm seeing that already.
Because that's going to be like the out now. That's going to be the hope. Because when this whole desire for cuts is fulfilled, basically, and you find out, oh, it's not for the right reason, that's kind of like your biggest fear, to be honest.
Well, yeah, all this is accurate. It can change in 16 hours when we get a payrolls number.
Agreed. Tomorrow's going to be, I mean, the pressure, so on.
Yeah.
If that comes in light, then I don't know what you would run to, because clearly you can't run to tech anymore. Too expensive. The rest of the market needs good season. Tomorrow's an opportunity.
Yeah, I mean, Apple, that'll be tricky.
Yeah. Boy, I feel like it's written on the wall for Apple at this
Amazon's
point.
got a much better chance to impress than Apple does.
Agreed, 100% there.
They'll make either could disappoint or impress. But I think it's, if you got to pick one of the two, it's Amazon. And then, well, you got a payroll number tomorrow that's just going to be incredible. Wages are such a big part of that payroll number. Remember, I say this all the time, the day before payrolls. The stock market doesn't always move on payroll day. Bonds always move.
Yeah, and they're definitely moving right now because they're expecting a light number already, a drop of like 25,000 from the previous NFP report. So they're already expecting it to be a little light. If they underestimate how light it will be, I mean, yeah, bombs away.
You probably can't have another 70,000 government jobs month after month.
Okay, let's talk this afternoon. By the way, 2-hour show because we got Apple. Amazon's got to have an easier go of it than I would think Apple. What could Apple do here to justify their most expensive valuation ever?
And okay, maybe they could say that their AI rollout is not going to be as delayed as they thought. Maybe we could see a surprise. I feel like that's what we have to see any upside. They have to shock. They have to unveil something that we weren't expecting. They
Still in it.
That maybe the iPhone 16 will
To
have
win it.
now their Apple Intelligence. Something of that nature that would
Break.
blow everything else out of the water.
No, you're totally right, actually, about the unveil. Laura Martin from Needham, that's what we talked about. This
Okay, now we're above the
almost
200, so I'm getting a little bit of, I can get out even right now, but I'm going to let it go as long as I'm above that 200. That's 63. Yay, Randy. 330. Oh yeah. This is how they do it. I should take a little profit right here. SPY. Let's see what CNBC has to say. They're probably not talking about the market. We're talking about stocks. Well, yep. Same things every day.
Meta is the classic example of how well somebody can use AI.
So every day, these guys, they all talk about the same stocks, more or less, both channels. And I've been calling them out every day. Amazon, Apple, Microsoft, Meta, Google. Now they're down. So I'd keep them on watch. Tesla, the ones at Magnificent Seven. These guys are in big denial that we're way overbought. Still. Now I'm back. It wasn't a good day for me today. Yoringa. Mentally, I mean, so I got a new, I guess I was insured, so I got a replacement phone again. This is number 3.
I really think this is a pivotal place for Apple, but I also expect them to show up and prove it in the September quarter to your point.
That was a song I was trying to write.
Of course, we're all over the sell-off as well. We're going to show you the major averages on your screen here. NASDAQ's leading it today, down near 3%. That's of the majors, but the Russell, 3 2/3% sell-off. We'll follow all of it. We're live at the New York Stock Exchange.
Yep, the Russell got me. May I ask you a question? Are you still pumping Meta? Yeah, I mean NVIDIA? I am. I got it working. What in the heck's... There I am.
Welcome back. Oil prices giving up down more than 1%, about 1 1/3 now, amid rising concerns over the U.S. economy. Joining us now, Post 9 famed oil trader Mark Fisher of MBF Clearing Corporation. Vertus's Joe Terranova is also with us. It's great to have you here in person on at Post 9. Welcome.
Thanks, Scott.
One of your headlines today, which I think is the most important for sort of actionable advice for people who are trading this, is you say August will be the most bullish intraday for energy than it's been in the last 4 years. Why do you say that?
We develop these systems kind of based on ridiculous concepts that I come up with, my team comes up with. And from next Tuesday, for the following 3 weeks, we could see the most bullish intraday patterns that we've seen in the last 3 years. And that hasn't happened in like 3-4 years from now.
In terms of being long crude?
Long crude, long cracks, you know, that whole sector. Not natural gas, just the whole natural gas. I mean, crude, Brent, heating oil, distillate, RBOB, that whole sector.
So you have your systems, but if you look for fundamentals to match up, maybe with that, is that because of heightened tensions in the Middle East? I mean, here we are talking about a potentially weakening economy dragging down the price of crude. So what's the push-pull on those two variables?
All those systems are all technical AI-based systems. They don't really look at fundamentals. But again, typically what happens in energy is on every weekend, the market usually sells off if nothing happens over a weekend. During the rolls, the market's usually weak. But this is the most intraday bullish week period we've seen in like years.
Is it related to the hurricane season?
No, not yet. No, hurricanes, maybe it could be. I mean, I guess the hurricane seasons is...
What about war, you idiots?
I think that obviously with what's going on with, I call it climate uncertainty, right? It could be, people, thinking that, cracks could explode, if something happens, in the refiners in the South. But
I feel like you nailed the call, I don't know, it feels like more than a year ago for certain, where you suggested that crude was going to stay in a range of like 70 to 90, which it basically has.
Right.
Given what you've said, and you're certainly talking on an intraday thing, so you're really talking about day trading crude. What's a number that we should keep in our heads about where you think crude oil could trade to? Is it coming out of that range?
No, it's not coming. I just think that it's a bullish pattern. We're coming out of that range for sure next year, though. We're breaking out of the 70 to 90.
One way or the other, or?
I think probably both. I think.
Not if Trump wins.
Major Wall Street firm is bearish oil, right? And with that being said,
not if Trump wins.
Funds are going to be long. The Bloomberg and the commodity index funds.
I disagree with the guy.
News, and that happened because no one's long, right? And so the way you really get the market to move is by getting, shorts in the market, and that's what's going to happen. I mean, everybody on Wall Street's bearish next year. They all think who's going to 60, 50, and when that happens, it usually surprises a lot of people.
Are they thinking that because they're thinking, well, if there's going to be a recession or a larger slowdown in the economy, well, naturally oil's going to be one of those things that gets hit?
One of the reasons, if Trump wins, they think, drill baby drill, but I really think that it's all convoluted in my opinion. I think that next year you can see the prices above $90 next year.
Interesting. So if I believe that, where do I want to invest most to take advantage of that? What part of the energy spectrum plays that the best?
Well, first of all, to me, being long refinery spreads, heating oil against crude, distillate against crude, gasoline against crude. Again, we're coming into a hurricane season. Who knows what's going to happen here? And the layup trade for me is eventually, hopefully, sooner rather than later, when there's a ceasefire in Gaza, right? And everyone's just going to puke the energies. You wait, I don't know, 48 hours, 24 hours, that'll be the bottom, because who's going to pay for the reconstruction of that whole area? It's going to be the oil consumer, right? Right? So in my opinion, that will be the tipping point.
What about refinery stocks?
Talk to him. The sector in general, I think is bulletproof.
Valero, Phillips 66, both very strong momentum, good-looking charts, and they've benefited from the tight range that you've talked about, and a stronger economy.
And if the crude gets cheaper, and the cracks stay wider, that only helps them, right? In a convoluted way, I mean, this is going to be going to the La Nina. You've got a lot of weather uncertainty out there, right? I just don't see how the refineries get really hit. You know what I'm doing with the whole, hurricane nonsense we're doing in Florida with all the products we're doing and stuff.
Can you talk about you sort of you didn't go specific on it,
Randy.
Usage of AI
6:30
to trade like you suggested you are. Your firm designing what sounded like proprietary AI models to help you trade. Is that what the future of certainly day trading is going to look like? Well, you use intraday trading, but you're...
Yeah, but that's not just been the future. That's been what's been going on for the past 5 years. The world's just woken up to it, right? Nothing's really changed. I mean, every day we learn something new, right? But, that whole learning curve and learning from past data, learning from past price performances and price charts, that's been going on forever.
Is it a universal application to all commodities, or is it just specific to oil?
We really only apply it to energy, but I'm sure if we're applying it to energy, people are applying it to grains, people are applying it to other things. We just don't have the expertise in that stuff.
I just feel like AI models can never take into account moves in the economy, geopolitical flare-ups around the world. So how do you factor all that in?
Well, that's where the human element comes in, because again, I think the AI models are going to get commoditized themselves. Eventually, it's going to be AI models competing with AI models, right? If you don't have some of the brain going, well, this is ridiculous, or this is, they're not going to work. You're still going to need the man, behind the strings to, to look at all the information, because otherwise, this whole space is going to just be everyone's going to eat everyone else's lunch.
Let me ask you lastly, Joe, because it plays into the rebalance. You bought Exxon, right? So that's new in the ETF, and you sold a handful of names, including Marathon Petroleum.
Yeah, the headline is, well, we kept in terms of refiners. I mentioned Phillips 66 and Valero. But the headline is that the energy exposure came down, and it should have come down. The energy exposure basically was cut in half from 10% to 5.5%. S&P energy exposure is around 3.3%, I think. So we're still above the benchmark on the S&P. But given what we've witnessed with a very tight range in energy, there's really not very much there in terms of momentum that you could capture. The one area that I did see is the excitement surrounding acquisitions. And there has been a lot of consolidation. There's been a lot of acquisitions that have happened in the energy space. And if Mark is talking about a 2025 with an oil price above $90 for the viewers, I think that's the real tailwind, trying to identify the targets, because you're going to see a lot more activity in that direction.
We'll leave it there. It's good to see you guys. Joe, thanks for hanging around. Of course, Fish, good to see you here at Post 9 exclusively with us on your view on what's happening in energy. Up next, we're trading the turbulence today. Citi's Lucy Baldwin is back. She'll tell us how she's navigating today's big sell-off in the areas of the market where she still sees big opportunities ahead, just after the break.
That was nice. Still a little red, but I like that.
Peacock.
Welcome back. Stocks giving back their post-Powell pop today on the heels of some weak economic data. Investors weighing a possible September rate cut against the risk of a greater economic slowdown. Joining me now is Lucy Baldwin, Global Head of Citi Research. Welcome back. It's good to see you.
Thanks, Scott. Great to be back.
Is that what this is about today? Now we're worried about the economy slowing down too much and the Fed being too late?
Well, you're right, Scott. We've had quite the week, haven't we, for the US market to digest. And in terms of what we've learned this week from the FOMC and from Powell, is this massive focus on the softening of the labour market, right? If you think about where we've been over the course of this year, we came into the year with most people expecting 6 or 7 rate cuts. And then obviously only a few months ago, most people had used the towel and said, look, you're not going to see that magnitude of rate cuts. Some people were even calling for the odd hike, right? Our view has been for a long time that you're going to see this softening come through in the labour market. And I think we are now finally really seeing that rhetoric bear out. And obviously, Powell very much focused on those asymmetric risks to the downside. And I think the way that unemployment has obviously crept up from 3.5% to 4.1%, it's crept up in a pattern that often precedes.
Going up more and I'm out.
So that's got a lot of people quite nervous. And I also
Damn,
think
I should have been watching that.
Kind of finally say we probably won this war on inflation, right? Some of the stickiest areas where you really struggled to bring inflation down earlier in the year, areas like shelter, that looks like it's finally under control. So the Fed can finally focus its attention on actually looking at this labour market in a lot of detail. And I think they're really quite concerned.
$7, buddy.
Our view. So our view is you're going to get this first cut in September. That's obviously now a view that everybody shares, and the market pretty much looking for these 3 cuts this year, and even sort of pricing 5 in for next year, predicated on these concerns. But it's a massive change that we've seen over the course of this year, and it's an awful lot for the market to digest.
I mean, I think people may agree with you that the Fed may have won the war on inflation, and I think they would believe that at this point. But the collateral damage, of course, is what have they done to the rest of the economy and to the consumer? And those long and variable lags that were really longer and really variable, perhaps much longer and more so than people expected them to be, but that they're finally showing up, and that history is going to at least rhyme, and that the Fed always sort of does what you know, when they start cutting rates, it's always too late, just like they were too late when they started hiking, and then it's just going to be too late to get out of that mess.
I think you may see a mild technical recession, right? But we're very constructive still, actually, in aggregate on equity markets. And I'll tell you a little bit about why that is and why we're not saying this is going to be some kind of major downturn here. I think when you look at the shape of earnings that we're seeing so far, obviously, the US is faring significantly better than Europe, right? You're seeing a number of companies at least come out and beat and hold their guidance. When we came in to this third quarter, we view from the S&P that you'd get to a 5,600 target at the end of the year. So implicitly, we were saying buy the pullbacks rather than being uber bullish. But it was still fairly selectively risk on. And our feeling is that within that bucket, you should hold on to your large cap, your Mag 7, and you should be adding selectively some of the interest rate exposed areas, whether that's banks, whether that's real estate, whether it's parts of consumer. But you're right, the big test is going to be how well the consumer can hold up and whether the Fed is going to do enough. Now, I think if you listen to the rhetoric that's coming out of Powell and the FOMC, you know, these 50 basis point cuts are not off the table, right? They're going to be looking at this data with a laser focus. That isn't our forecast. We think we're going to get the 325 cuts this year starting in September. But I think there is that risk that if they need to do more, they will do more to try and ensure as close to a soft landing as we can possibly get.
You make the argument that the small cap trade has legs. It certainly doesn't look like it today. And if there remain questions about the durability of the economy, how's that trade going to work?
Yeah.
And you're right, it is very much a trade. And I think when you think about, you know, where we've come from this year, right, if you look at the first half performance of the S&P, a third of it is obviously one very large mega cap chip design company. The other Mag 7 make up another third of that 15% performance, and the other third is the other 493 names. There's been this thesis that we've had, and others have had for a while, which is that you start to see this broadening out. And of course, we had that one day after the June CPI print when you saw the NASDAQ underperforming the small caps by 6%, which was quite extraordinary. And a lot of clients asking us, can that continue? Now, as you say, we be a trade that makes some sense, but you have to look at the long term. And if you go back over 80 years, there's only about half a dozen times in history when small cap names have actually outperformed large cap for a sustainable period in the US. And that's for very good reason. If you look at large cap earnings over multiple downturns, and if you certainly look since the GFC, they've been significantly more resilient during periods of pullback, much less volatility, as well as just overall better growth. And on every metric, whether it's free cash flow margin, whether it's returns, whether it's the debt profile and debt dynamics, you would argue that fundamentally those large cap names are structurally much better placed. It's something like 40% now of the small cap names that are actually unprofitable. So although we would say yes, because valuation has become unbelievably stretched and they look incredibly cheap in aggregate, those small cap names versus history, we would tread pretty carefully, and we would very much view it as a trade that is a trade to take advantage of the fact that we likely see these rate cuts coming through and that narrative around a soft landing starting to come back into the market as people get confidence that the Fed is going to manage to land this plane in a soft fashion, Scott.
Okay, we'll talk to you soon. Lucy, thank you. Lucy Baldwin of Citi. Up next, we're tracking the biggest movers as we head towards the close. Shares of Eli Lilly are popping and Hims and Hers dropping. We're going to tell you what's behind both of those moves. And as we head out, another look at the majors. We're heading towards the close. Looks like it's going to be a little bit of a nasty one, too. Closing bell's coming right back.
T-Day Cohen maintains a hold on Carvana, raises price target to 148. But I got one better than that. BTIG maintains a buy on Carvana, raises price target to 188.
business.
We're less than 15 from the closing bell to Angelica Peebles now for a look at a pair of stocks moving into the close. Angelica?
Yeah, Scott. Lilly's sharing some new data today showing that its obesity drug Zepbound can help with heart failure. Now, Zepbound cuts the risk of heart failure worsening by 38% compared to placebo, and you're now seeing those shares up about 3% today. And Lilly CEO David Ricks speaking in Paris saying that Zepbound should come off the FDA's shortage list soon. Now, Hims and Hers are taking a big hit on those combos. Remember, it wasn't that long ago that the company said that they will start selling a compounded version of Novo's Wegovy. Generally, you can only compound large amounts of a drug when it's in shortage, and that's been a big risk since the beginning, that these drugs would eventually come out of shortage. Now, a Lilly spokesperson telling me that supply remains dynamic and that ultimately the FDA will decide when to update the shortage list. We'll let you know when we learn more. Scott?
Angelica, thank you. Angelica Peebles up next. Amazon and Intel reporting at the top of the hour. We are less than an hour away as well from Apple's results. We're going to run you through all of the key themes you need to look out for from all of those names. We'll do it in the zone.
Okay. All right. Thanks for the heads up. Appreciate that. Nice looking amount though, 0.88. Like it's you know, it's a
like
very
a lucky
fastidious
number.
price. Yeah, 88. Okay. Kind of looks like the WW. All right. Thanks, Jake. We got to jump when we come back. And Pearson taking us into the bell as we talk big picture and look at the derivatives market some more. Stocks right now up off the lows.
Trading the trending names.
7 more minutes.
It's Fast Market. Ready for you, ready to go. I'm Kevin Higgs. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
I'm Nicole Pedalides, live from the New York Stock Exchange. Catch me on Schwab Network anytime, anywhere, on any device for free. Schwab Network.
Neil, how's my favorite client?
Quick question, Carl. Can you offer me the same choices as Schwab?
Choices?
Yeah. At Schwab, I can get full-service wealth management, advice, and invest and trade on my own.
Come on, you know Carl's the only choice you need, right? Neil, tell me you know this.
Gotta run, Carl.
Schwab.
Have a choice in how you invest with Schwab.
Mara's down to 18-13.
All right, Nate Peterson joined me for a walk into the closing bell here. We got 7 minutes left. Nate, we're trying to take this little bid in the last hour and turn it into something. What do you think?
Yeah, maybe Apple and Amazon can provide a little bit of
just can't provide
here.
Provide of any form. If they can just provide.
No kidding, yeah. So what a day. And, Oliver, I think this is pretty significant. This might turn out to be a significant day. This doesn't really have to do with the FOMC, although the Fed is tied into it. And it's obviously, if you think about economic data and bond yields and stocks, the most leading indicator is the bond market, at least historically. Yeah, the bond market has not been a great indicator over the past 3 years or so. The Fed's been wrong. The bond market's been wrong. The rate cut probabilities have been wrong. I get it. But if you go back on a longer term basis, the leading indicator is the bond market. And it really has to do with, the initial claims hitting an 11-month high and the continuing claims being at the highest level since November of 2021 and providing some tentativeness ahead of tomorrow's non-farm payrolls report. And the bond market is saying this is about slowing growth, or there's an uptick, at least in the probability of a recession, which is not being priced into the market. And you can tell from the price action, it's not just the breach of the 4% level on the 10-year, it's also coupled with the 3.5% move down in the Russell, which tells you, hey, wait, Russell's supposed to be doing good when the rates are going down. Yeah, this is a growth scare. That's the message that the market is sending. If you look at technology, basically unwound yesterday's oversold bounce that we saw within the chips. And, we're really testing. If you look at the NASDAQ 100 last week, we came down to the 100-day SMA and we bounced off of there. And you thought, okay, that was about 10% we got from the highs. Looks like your standard correction. But then if you look at this week's price action, we kind of came up to the underside of the 50-day SMA and we're getting rejected there. So right now, it's just, it's really potentially a repricing and concerns about growth. And, we've seen, if you look at Dudley's comments last week, he talked about the McKelvey indicator that's already in recession territory. He said he's changed his mind. The Fed should be cutting. We've got, unemployment rate's supposed to be 4.1% tomorrow, but if it's 4.2, some rule gets triggered.
Thin line we've got.
Yeah, so it's the culmination of all of that, and then you're like, oh wait, this market at a forward P of 20 is not priced for slowing growth. It's been priced for an earnings pickup, and the move in the Russell is telling you that we're not early cycle, we're late cycle.
Bingo.
We're not supposed to be in small caps.
Bingo. It's amazing to me, that this narrative got built around. It's like people really, same way that the yield curve stuff, I get that gets a little bit murky because it's this wide range of time, but still the point is that the uninversion happens later in the cycle, and then the Russell is the stuff you buy after you are coming out the other side of the hit. Running up beforehand historically is not what you're supposed to be doing. So people are literally betting that this time is different. That's what they've been doing for 3 weeks up until this past week.
More than 3 weeks, buddy.
Exactly. Yeah, and you look
We've been
at
talking
what
about it
sectors
for
are
months.
Real estate, healthcare, utilities, those defensive, you're dusting off now your defensive playbook for slowing growth / recession. I'm not saying that, we need to be concerned about a recession at this point, but we continue to get these incremental data points that are suggesting that, hey, maybe we do need to pay attention and look at, it's idiosyncratic, but look at the commentary from the CEO of Wayfair, who said basically the pullback in their home goods spending was the peak to trough biggest decline that he's seen since the great financial crisis. Now, that's only one company, but we've also heard from Starbucks, McDonald's, etc. about the consumer slowing, and the consumer is everything. And with all this talk about inflation being normalized and coming down and the disinflationary trends, let's keep in mind this consumer is getting hit because the price index level is still basically near all-time highs.
Yes.
So this consumer is getting hit, slowing is happening, and the market just isn't priced for it. Throw in the yen carry trade unwind from the Thank You Bank of Japan that raised rates this week, and then you get a big down day like we have today.
Yeah, and you hit it, nailed it. So we'll see if the wall of worry gets climbed, but boy, it's got there's a lot of big and compelling bricks in there. Appreciate Nate, good stuff. Nice summary. Good way to close this out. Nate Peterson, Director of Derivatives Analysis at Schwab Center for Financial Research. All right, 90 seconds until the bell. We'll see if we can get back close to that 54.50.
Trading at Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths stacked.
All right. Well, I've talked about the psychology of trading. I've mentioned it many times. I come in here today with, not feeling very good, for one, because my business is structured around my telephone. My telephone was out, and I just felt stupid for not thinking about putting that phone in my front pocket and then bending over and watching it plop in the toilet. I mean, I just felt so stupid, miserable, and then I get to my other job and I'm using my vacuum cleaner and I break the cord thing on it and I'm going, what's next? What's next? So probably shouldn't have traded at all today, maybe, but I called that put perfect. Maybe if I was in my right head, I'd have held on to that more. And then I got in the call, the IWM, and that just screwed me up. Or the SPX, I forgot which one it was. So I'm going to take a break, go get some trash bags, and come back, get a good night's rest. So I think everybody, just when you got stuff on your mind or you're not feeling up to par, just like an athlete, do something else. Occupy your time. Unless you think you can trade during pressure, intense. Depends on, we all have different personalities too. So I'm going to get out of here. I'm red, but not that bad as it was. I had to sit here all day and wait before I saw the reversal pattern. So I'm going to get on out of here. Thank you, Josh.